A quiet crack just ran through the tape, fractures and spreads, signals flipped, and the data turned hostile for shorts. Delivery and price gaps reversed together. An irregular move you see only when a big desk changes sides. Call options suddenly cost more than puts, and big orders hit late, after most traders left. It echoes old warnings. Before the 2011 silver squeeze, the 2018 volatility shock, and the 220 cash crunch, these same patterns resurfaced. The whisper is simple. JP Morgan flipped long, and the street is not ready. Stay with me, tap subscribe, like the video, and support this channel. Then watch the full story so you do not miss the next move. Follow the trail because of the evidence around they flipped long, JP Morgan just switched sides, insider leak, is becoming impossible to ignore. We test the claim head on. JP Morgan flipped long. Rumors are noise, footprints are truth. So we track public signs, position reports, custody moves, and the way orders hit the tape. It is like reading footprints in fresh snow. You will not see the person, but you will see where they went. The first signal is positioning. Recent dealer net shorts and CFTC data shrank faster than usual into the roll. That is odd when price is flat. The second signal is delivery. CME notices rose while the term basis compressed, a pattern that often means someone wants the real stuff, not just paper. EFP flow spiked too, shifting risk from futures into the over-the-counter alley. One bank can do that. Few need to. History rhymes here. Before silver's 2011 surge, dealer shorts retreated, warehouse draws picked up, and call demand crept higher. The same echoes are faint today. The red flag now is how quickly the curve tightened after month end, like a chess player switching from defense to offense mid-game. But key questions remain. Is this the bank's own book, or are they quietly hedging a large client? Are swaps masking the true side until the next report? Is the leak a decoy to wrong-foot copycats? Those unknowns keep the case open. If the flip is real, the risk dominoes lean the other way. Short hedgers will feel pressure, liquidity will thin on downticks, volatility can migrate across assets. This connects to our larger story. When a house this large turns, the street must pivot with it or get caught on the wrong side of the trade. Just as the earlier signals hinted, the clearest fingerprints sit in futures. The dealer category in CFTC data has been trimming net shorts into the roll, while price barely moved. When price is calm but open interest falls, it often means shorts are backing out, not fresh longs chasing. On the CME, delivery notices ticked higher, and the term basis narrowed across near months. That looks like a hand reaching for the metal, not a trader flipping paper, like moving cargo from a rental truck into a private vault. EFP flow adds weight. Exchange for physicals spiked on several sessions, shifting exposure off the screen and into bilateral lanes. One desk with balance sheet can do that at scale. The irregularity is the timing. The shift clustered right after month end, when desks usually smooth risk, not change direction. In 2016, before gold's sharp climb, a similar pattern showed up. Dealer shorts cooled, EFPs grew, and nearby basis tightened. History does not repeat, but it leaves tracks. Yet we still lack a name. Are these prints JP Morgan hedging client flow, or the house book leaning long? Did they move part of the position into swaps or options, masking the true net until the next report? If so, the trail goes dim for a week. The connection to our larger story is straightforward. If a large dealer is migrating from net short to net long in key metals and related futures, liquidity on the offer thins and upside gaps become easier. Think of a bridge where one support is quietly removed. It holds, then sags, then shifts. If the flip is real, that sag becomes a tilt. Options are where fear and hope get priced in real time. Lately, the tape shows a kink. Upside calls are suddenly more expensive than they were, not just in level, but in shape. The smile bent upward on the call side, and front-month calls now carry more implied volatility than later months. In plain terms, traders are paying up for near-term upside, like buying storm insurance when the sky is still blue. That is an irregular turn. For months, put protection led the way. Now, risk reversals flipped toward calls, and the heavy flow sits 5 to 10% above spot. Calendar spreads also shifted. Near-dated call calendars were bid, while farther out calls did not move as much. This kind of curvature change is rare without a tangible trigger. Before gold's 2016 surge and ahead of silver's sharp 2020 summer run, the same pattern showed up. Call wings went rich while the spot price lagged. History does not guarantee, but it often signals. The red flag is timing and clustering. The biggest prints landed late day after liquidity thins, and they repeated across two expiries. That looks like someone building a shield, piece by piece, rather than a casual punt. Yet a key question remains. Is this a dealer covering short calls from earlier, a client buying a structured hedge, or a housebook preparing for a catalyst not yet public? If JP Morgan did flip long, this options kink fits the larger story. When a major dealer wants upside, it stops selling calls and starts owning them or hedging them, so the market's ceiling rises. It is like removing sandbags from one riverbank and stacking them on the other. The flow shifts and pressure moves with it. Just as the earlier signals hinted, the cracks are clearest in funding. In repo, key metal contracts went special, with borrow costs below normal loans. GC spreads swung wider than usual, then snapped back, an unstable heartbeat. The ETF NAV gap also flipped. Funds that usually sit near zero traded at a steady premium, with shares briefly worth more than the metal. When the gap between futures and spot shrinks while ETFs go premium, it often means someone is locking down deliverable supply. In securities lending, we see odd moves. Borrow fees were re-rated higher on short notice, recalls ticked up, late day locate confirms slowed. This is the kind of friction you see when a big lender withholds inventory. During the 2011 silver squeeze and March 2020's collateral scramble, specials clustered and ETF premiums lasted for days, not hours. Today's cluster is smaller, but the shape rhymes. The unanswered question is motive. Is a major dealer ring-fencing bars for its own long or protecting a client's forward need? Are they stepping back from lending to pressure shorts or just managing balance sheet? One valve closing can make the whole system hiss. Think of a city water grid. Shut one main and gauges everywhere flicker. If JP Morgan did flip long, these fractures fit the story. A longhouse keeps collateral close, recalls borrow, and stops leaning on the offer. Liquidity thins, basis tightens, and the bid gains teeth. The tape says someone large prefers possession over promises, and that will shape how the next shock travels. Just as the earlier signals hinted, the next layer is inventory and custody. Warehouse logs show a quiet shift. Registered stocks slipped while eligible stocks grew. In plain terms, less metal is available to deliver, more is parked under hands-off status. That is the kind of move a strong holder makes when it plans to sit tight. ETF flows back this up. 2 major metal funds printed back-to-back creation days, even with price flat. Creations without a rally are unusual. It means someone wanted shares now, pushing the fund to pull in bars. One creation basket landed near the close and was larger than most days this quarter. That timing is a tell. Custody transfers add another clue. Serial numbered bars left one depository and reappeared at another as segregated, with fewer shares available to loan. After hours, adjustments in warehouse reports also spiked. In 2011, before silver's surge, registered stocks fell for weeks while ETF holdings rose. In March 2020, ETF creation soaked up supply and tightened spreads. The shape we see today rhymes with both. The red flag is pace. These moves clustered in 3 sessions, then went quiet, as if someone finished loading pallets and shut the door. But who? Is this JP Morgan ring-fencing metal for its own long, or securing a client's future need? Is a swap unwind hiding the true position until the next report? If the bank flipped long, this is how it would look. Move inventory from shelf to back room, stop lending it, and let the market feel the shortage. Like a shopkeeper locking the display case, the signal is not loud, but the absence is. Pressure moves to the offer, and the story tightens. The public voice and the trading book rarely sing the same song. Recent house research across the street still uses calm words like range-bound, balanced risks, and sell strength, yet the footprints we have tracked, richer call skew, tighter basis, ETF premiums, and heavier EFPs, say someone is leaning the other way. When the window display says winter, but the stockroom fills with swimwear, you know plans changed. The irregularity sits in timing. The tone of notes barely moved for weeks, then shifted only after prices jumped, not before. Quote, sizes on the offer also thinned just as reports urged patience. That lag is a tell. In 2011, before silver's spike, several shops stayed cautious while warehouse draws and call demand climbed. In early 2016, research talked about deflation and slow growth even as dealer shorts faded ahead of gold's rally. In February 2018, calm commentary on carry contrasted with desks quietly buying protection before the vol shock. The pattern? The book turns first, the brochure catches up later. What we still do not know is intent. Is the soft tone a natural result of compliance walls, where research cannot see the desk? Is it a decoy to keep liquidity friendly while a large position is built? Or is a client mandate forcing hedges that make the book look long even if the house view has not changed? If JP Morgan did flip long, this gap between words and actions makes sense. A longhouse sells fewer calls, recalls inventory, and lets the tape speak while the notes stay neutral. Like a choir singing lullaby while the drummer quickens the beat, the surface stays calm, but the rhythm has changed, and the market will soon move to it. Map the spark in the chain. The likely triggers sit in 3 groups. First, supply and custody, a delivery jam at month end, a large central bank purchase, or a refinery outage that slows bar flow. Second, policy and plumbing, a margin hike, a change in clearing haircuts, or a new bank rule that makes lending metal less attractive. Third, macro shock, a sudden drop in growth data, a sanction that traps inventory, or a dollar wobble that pushes buyers into hard assets. Any one match can light the field when grass is this dry. The spread path looks familiar. A squeeze starts in near-dated futures, basis tightens, ETFs trade at premium, and shorts rush to cover. Options makers must buy spot to hedge rich calls, which adds fuel. Miners gap up, then credit spreads notice as volatility rises. Repo grows jumpy, specials multiply. Equity risk slips as funds sell what they can to fund what they must. In 2011, silver. In March 2020, collateral stress. And in the 2022 nickel spiral, a local fire jumped fences fast. The pattern is the same. Hedges fail. Rules tighten, and price outruns models. The current red flag is clustering, late day prints, repeat ETF creations, and a sharper call skew ahead of news. The open question is motive. Is a large dealer front-running a client need or bracing for a hidden policy shift? If JP Morgan did flip long, this map shows how pressure can travel like a row of dominoes, one leaning on the next. The pace may feel slow, then suddenly quick. When strong hands hold the metal and step back from the offer, the next catalyst does not need to be big to move the tape. The evidence lines up. Futures show shorts shrinking while price was calm. Options now pay up for near-term upside. Funding is uneven, specials, recalls, and wider spreads. Inventories drift from registered to eligible, while ETF shares get created on flat days. Research stays mild even as quotes thin on the offer. Each clue stands on its own, but together they point one way. Stronger hands are taking supply and reducing the street's willingness to sell rallies. Two truths can exist at once. The leak can be wrong in detail, client versus house, swaps versus futures, yet still be right in direction. And timing can stretch. Quiet accumulation takes days, and markets rarely reward late arrivals. The real risk is not a straight line up. It is a thin market that jumps, then rests, then jumps again. That is how squeezes and regime shifts tend to look. What to watch now is simple and sober. Do dealer shorts keep falling? Do registered stocks keep slipping? Do ETF premiums and creations show up on dull price days? Does call skew stay bid into events? If these repeat, a flip is no longer a rumor. It is posture. The next spark, policy, plumbing, or supply, would then travel fast across metals, miners, credit, and funding. It would not need to be loud to be real. Stay focused on the footprints, because once the dominoes lean, the smallest push can start the run.